We're looking at shipping, staples, and semis in today's earnings exchange. Here with our trades, the CNBC contributor Delano Saporu of New Street Advisors. Delano, it's good to see you again. Welcome back. Let's start with FedEx, which reports after the bell today, and the shares hit a 52-week high yesterday on a 10% run in just the past month. Barclays says FedEx should benefit from improvement in package demand and cost cutting, and is watching for updates on its plans to merge its express and ground operations. And what do you say about the stock here, Delano? You a buyer?
Yeah, I think I am a buyer, and I've been holding the stock for a while. And I think some of the reasons mentioned were why. So the e-commerce trend, I think, is still favorable for FedEx. The new management team has also pointed to, the ability to restructure and do different things for costs, and I think they've been doing well with that. The play is from April to expand and drive operating margin about 10%, and I think that play works out. I think if you look at also the management's dividend repurchase plan and also their boosting of dividends, that's also pointing to the management's belief in their plan as well. So I think one thing that can help is the drop in crude oil. That's helping a lot of obviously these consumer discretionary companies that are doing the packaging and shipping, and that's going to help a lot of their business segments as well. Last thing is the valuation. I think if you look at it, when it gets to price to sales, it gets roughly to about 1x. That's when it's possibly time to trim a little bit of shares. Right now, it's below that, and I think that's an opportunity for buyers. If you look at the revenue, has actually been slower over the past few quarters. I think that they could boost that a little bit, and that could be opportunity for investors there.
All right, amazing run this year, really. I mean, I know they've had their challenges, but up 63%, still below a 15 PE for what it's worth. Let's turn our attention to General Mills then, which reports tomorrow morning. That stock, different story. It's down 21% since Jan 1. RBC expects the shares to stay under pressure, pointing to slower than expected volume growth, increased pressure on the pet category, interestingly, and product disinflation because falling prices in the perimeter of grocery stores is pulling customers away from the center where prices have been stickier. You part of the bears on this one, Delano, or would you pick it up here on the cheap?
Yeah, I am part of the bears on this one. This was one I'm not holding, and I think there's a few reasons why. The big one that was mentioned was volume. So if you look at a lot of the things that these consumer discretionary companies are doing right now is to boost revenue. They're obviously doing different things to drive that revenue by different product things. But for them, obviously, the consumer is weakening. And I think the volume is the interesting part because the price increases aren't going to be able to make up for that in a lot of cases. So, for me, it's one that I've been fading. I think for income investors that are looking for a dividend that's actually been strong for a very long time, this might be a play for them. But if you look at the price performance, someone that's looking at growth and strong price performance, that's one I'd probably continue to fade.
Continue to fade General Mills. That's up to them. Give us some better numbers in the morning. Finally, Micron. Shares are up 60% this year, interestingly, rivaling FedEx. And they're hitting a 52-week high late last week. Most of the street is expecting some positive results and looking to higher pricing on Micron's memory chips, stabilizing demand for PCs and smartphones, and more inventory stabilization. Although Morgan Stanley warns this rally might have already discounted the upturn. Where do you fall on this one, Delano?
Yeah, this is what's on my watch list. And currently, obviously, I'm not holding shares right now, but I think the big trend I'm watching is if something's going to be used, obviously, more over time. And I think the big driver in 2024 for Micron and a lot of these memory chip companies is going to be AI and how that positions their business going forward. I think there's going to be a lot more demand, obviously, for companies like Micron and all these different semiconductor companies. And I think that's why I'd be a buyer here. And I think some of that is potentially priced in now with the big, as you mentioned, the big strong price performance over the last several months. But I think some of that's not priced in because if you look at the volatile year, Micron's had, especially with the inventory issues and different things of that nature, geopolitical issues with China. Those are some things that have been pushing down the price. But I think if you look further out, those are the AI demand is definitely that's going to drive the price forward. And I think that's the reason why it should be on your watch list.
Indeed. Delano, thank you. It'll be a busy 24 hours. We appreciate your time today. Delano Saporu with our trades.